There's a game I play with my friends called I Should Have Known That.
Okay.
And it's full of trivia that you should know. Like, and I think
you already prefaced this with saying, I'm not going to know it.
Well, but that's the point of this, is that you should know it. Like, we all should know the things in like that this game asks.
All right.
And yet most of us don't.
Yeah, we don't.
I have two friends that are more reliably going to know these things. What's funny is it's American. The game is American. And my friend Guru, who is from Turkey and the UK,
he knows more about it.
Dude, you got a better education than I did. Anyway,
that's true. All right. Lay it on me.
I'm sitting at dinner last night with Jess and
at the Wilder.
At the Wilder. And we were talking about the day and clients that we met with recently. And I was talking about a client that came in who had fired.
Yeah.
Right. And had successfully navigated the period of her life where she retired early, but didn't have access to her retirement accounts without penalty.
Right.
And I was explaining that she came in right after her 59 and a half birthday to, figure out a plan for having access to the retirement accounts.
Sure.
And Jess says, what? I said, 59 and a half. She's like, 59 and a half? And I'm like, yeah. And she's like, why? Why is that when you have access to your retirement accounts? And I said, I don't know.
Because that's the rule.
She said it seems really arbitrary. So my question to you, Colin, is why is it 59 and a half?
Ooh. I'm trying to think of a good response.
Something that will sound smart.
Reason.
Yeah.
The thing that hangs me up is the half.
Right.
Is it...
I think that's what hung Jess up too.
Is it because that's the average 40-year tenure of being in work or something?
That's a really good guess. I like that you had thought behind your guess. You know what the answer is?
What?
Jess was right. It's arbitrary. It's totally
There's literally
random.
No reason.
Congress decided that it's 59 and a half because it felt like a compromise. That's the reason. In 1976 with the ERISA Act, they landed on that because it wasn't quite 60 and it wasn't 59.
That's such a stupid thing to argue about.
Why do we have... Yeah. This is just a group of elected officials who couldn't figure out a solution without coming up with a random...
Everybody wins. 59 in 6 months. It's funny how there's just zero thought put into that. Yeah. I don't understand that.
Monkeys in a dartboard.
Why was it also 59 and 60?
Again, 60 was hey, I've hit 60 and that's the retirement benchmark. And then one side's yeah, but you want to be able to have early access. So 59. And then it's
I can appreciate having penalties and restrictions that discourage you from making withdrawals because you wanted to be in there and you wanted to compound and all that other
There's no
stuff.
arguing with the 10% penalty, I feel.
No, everybody understands the purpose behind that.
Yeah.
But the half, I don't know. That's kind of funny.
But you got to figure the 10% is also fairly arbitrary. It's
totally.
How do we decide? It's just bad enough, but not so bad.
I'm sure there were a million studies done, paid for absorbently by the government to figure out whether 8% or 12% was good, and then they landed on 10.
I think this is actually the perfect example of 1970s U.S. government. It's just we're so exhausted by everything. I don't care anymore.
Just put a half in it.
Just throw something on there.
Yeah, I don't even care.
Welcome to the Compound Growth Podcast with Colin and Wheeler, where we talk all things growth. From financial growth to career growth, personal development to societal progress, we explore how each layer builds on the next, compounding over time to shape who we become. Each week, we break down complex ideas and emerging trends into clear, actionable insights. Because growth isn't just about numbers. It's about understanding the world and our place in it. All right, so...
Market recaps today.
Market recap, another episode of what just happened for February 2026. We, of course, are still recording this in February.
Yes.
We have a tendency to do this where we risk that there's 2 or 3 more market days that could change everything.
That actually happened. Was it last month or the time before where we were talking about silver?
Oh God, yes, that's right. we were talking about how silver would definitely be lower the next time we talk, which is true.
Which was true, but then the episode aired the day after it had already crashed.
It's true. It's true. We were right though, and there's a couple things that we're going to get some flowers for today. because we've been right on a couple of things. And
we have,
and it's really important to address them.
We'll gloss over the things we were wrong about.
We're never going to focus on.
We'll just cut those out.
We've learned from those things already, so we don't have to talk about them anymore.
That's fair enough. All right. So where do you want to start today?
I want to start. Let's start with just a quick update on month-to-date returns, because there's some real disparity in the month-to-date returns. So
yes,
I'm going to throw them out right now. First and foremost, U.S. markets generally flat, right?
Yeah.
Bond markets like up 1%. So U.S. large cap stock, the indexes that we're all talking about and focusing on, the NASDAQ and the Dow and the S&P 500, flat, right? Outperforming. Gold, 6% to date.
Yeah.
Emerging markets, another 6% month to date. Europe, small caps, both up 3.5% as of this recording. Down. Bitcoin, down 14%.
As of where we are right now, 68,000.
Yeah. And that again, 14% just this month.
Right.
Software stocks getting crushed, down 10% just this month.
Absolutely smoked.
Right.
Yep. Nvidia had earnings too.
Nvidia just
dominated market action.
Nvidia reported earnings that were 73% higher than a year ago.
Yep.
73% growth. They opened up 1% and then they just turned negative.
What blows my mind about that is it's one thing to be a small company and have like 73% growth in a year because you're coming to market. People are like adopting your products and everything like that. But to already be one of the largest companies in the world and have 73% growth is unheard of.
Unreal. And it's not good enough. That
and
is
you're
not
down.
Good enough. What about next year? Every time they have earnings now, it's like, well, now because everybody's spending money. But what about when they stop?
Yeah.
And then they keep spending money. And Nvidia just gets cheaper to own because the price isn't really appreciating at the pace of their return, like their return on equity.
Yeah, it's actually not overpriced. Everybody says like, oh, the stock's gone up so much, I don't want to get in now. But if you look at PE, like it's reasonable.
I mean, we say it's not overpriced, but I guess we don't get to determine.
It's all relative.
We don't get to determine the price. But you know what's flying? Like stocks like Deere and Caterpillar are up 20% each this month.
They're crushing it. And we should probably talk about why a little bit. Do you want to get into it?
Yeah. And one more before we get into that. Energy stocks, the top performing energy stocks are up on average 30% this month.
Really?
Yeah. Which is insane. Like Texas Pacific Land Trust is up like 46%, for example. You know what? Do you know what Texas Pacific Land Trust is?
No.
It's property. It's just like the ground and then therefore the oil underneath it. And it's literally a trust that was created by a family that owned all that land.
Is it a REIT?
Nope.
Okay. It's just privately owned land that you can participate in.
You might think it would be a REIT, but it's not. No, it's literally a trust. So anyway, that's a really complicated stock to own and explain.
We don't have to.
But let's talk about what's going on here. Why are the John Deere's and Caterpillars and energy stocks of the world flying high while software stocks are going low? And I don't want to jump too far into your thing.
Right. But I think it's a good thing to unpack because ultimately the reason why a lot of these software stocks are going down is because capital expenditures, a lot of these build outs, and who's benefiting from that?
Nvidia. Yeah. So Nvidia, AMD, some of these Broadcom, some of those, the builders of AI are benefiting right now.
Right.
Although not as much as you might think.
Yeah.
And then the kind of the more tangible assets, the Deeres and the Caterpillars of the world, that's like the next derivative of we have the AI and now it's going to make our companies better. You have a company like Allison Transmissions, like one of the most boring companies in the world. And it's up 16% this month.
Right.
You know, what do you think about the Salesforce and Workdays and all these software stocks that are getting crushed?
I think it's extremely expensive to build out your own LLM. And I think a lot of companies are spending an exorbitant amount of money on those things. But with Salesforce and a lot of these SaaS programs in general, I understand why they were so popular, going back like in COVID days, like what an absolute game changer. We actually added Salesforce onto our own practice when COVID was coming out, when we were back at our other firm. And it was really a game changer to the way that we operated.
Huge. Yeah.
But now with compliance, you can't do this yet, but there is definitely a foreseeable world in the future where AI will just be able to do everything that these CRMs are able to do without needing to pay an exorbitant amount of money for the build out. We've built these things out before. We know how much they cost.
Yeah,
And for
we're
a small
small.
business,
Yeah.
it was very, very expensive and
Yeah.
many times cost prohibitive.
Yeah.
You can literally take, we're not going to do this, but if you didn't have the SEC and FINRA and all of these things, and if you just had a small business, you could literally just feed it in all of the data and have a business, I'll say, subscription to one of these things. And it will just build out the CRM for you. And you can ask it, how many clients do I have over the age of 50?
Mhm.
How many clients do I have in New Hampshire? How many clients, bought X product over the last month? And you don't have to go through and generate reports and search records. It just knows it because it can compute the data.
Yeah, I think I get that conceptually all of these SaaS companies can be disrupted by AI providing the same service at a lower cost.
Right.
I think that the time it takes to get AI in that place is going to be exorbitant. I think it's going to be very expensive because we're always talking about the capabilities of AI. We're not talking about how much it costs. And we have AI as a team here that, we utilize for small projects. We're not using it heavily for like anything that's
like client data.
Yeah, like anything that we're not like running models on AI or
No.
we don't. But what we are doing is using it in limited capacity and bumping up against capacity where price goes up, right?
Yep.
Or you can do a little bit more in a couple hours, come back to us later.
Right.
And it costs a lot to run AI.
Yes.
It costs a lot in terms of, money on the company's bottom line, but also just energy usage.
100%. Yeah, I mean, that's one of the reasons why all these energy companies are spiking up is because the amount of energy required to run these systems is crazy.
Right.
And I even had the other day, I was trying to use ChatGPT to do a bunch of stuff for our own personal finances and some house stuff. And like my computer was getting very hot.
Yeah. Really?
Yeah.
And
like
that's not
the
even
fan was
running
going
locally.
and everything. No, I know.
Wow.
But it was just going and going. And I'm like, well, maybe it was just my computer that was being crappy.
Time for a new
computer. But still, it took a long time for it to render stuff up. And, it took a lot of data to download all of this stuff. But getting back to the software as a service and those whole things, I'm not necessarily saying that AI is going to replace those SaaS services, but I think a lot of those companies are having to spend a lot of money to incorporate AI into their existing offerings.
Yeah.
And we've talked about that because a lot of the software programs that we use are now coming out with like AI features and add-ons and things like that. And to do all that stuff and make it secure and compliant and user friendly is expensive.
Yeah. Yeah. So I think Tom Lee calls this ready, fire, aim. You're not paying attention to what you're doing. You're just like, AI is coming. I got to sell everything. And I think when you look at, the Salesforce and the Workdays, the stocks are down 40 or 60%.
Yeah, smoked.
I recognize that their path to continued growth and prosperity is harder. I also think that they will be able to utilize AI to improve their services. I think we're overdoing it because that's what we always do. We had that one article came out about like a future where 2 years from now, these people imagined looking back and saying, here's how AI took over all of the white collar jobs, including ours. 2028, we're out of job here. And that article, because of the algorithms and, maybe I guess some jittery traders, sent markets down 1.8%.
Yeah.
On a theoretical exercise. Like it's scary and people, I feel it's easy to be scared of AI. And I think people are buying into that.
We did a podcast with Bryce Gillis. If it's not out by the time this comes
It will not be. It'll be out like 3 weeks after this
but
one.
you should definitely check it out because it's a very good one.
Yeah.
And he talks about markets being propped up by assumptions.
Mm-hmm. Or sent down by assumptions.
And I think it's a very good point that a lot of what's out there right now is hearsay.
Yeah.
And fear or optimism about the way things are going to go.
Yeah.
And I think it's anyone's best guess.
Yeah. You know what is not hearsay? Private credit cockroaches.
Are we going to dive into this today?
We have to spend a few minutes.
Okay, let's talk about Blue Owl.
Blue Owl is one of the biggest news items of February 2026. Just a real quick couple minutes here.
First off, what is Blue Owl?
So Blue Owl is a private credit company. Do they have private equity as well?
So they have different offerings in their private credit options. So they have, I don't believe it's private equity. I believe they only offer private credit. But they have their tech fund, and then they have a general private credit fund as well. They have certain offerings.
And I think they have a couple of funds beyond the ones that we've looked at in the past.
Yep.
But essentially, what we've been hearing for the last few years is that all of private equity and private credit opportunities have been restricted to the haves and not the have-nots. It's always the 1%ers who get to benefit from these companies that are private and growing rapidly, or they get like these more attractive loan deals that can be offered through Blue Owl instead of JP Morgan Chase. And it's money that's up for grabs, and it's really helping the rich stay richer. And now we have to consider putting that into everybody's accounts. And why don't we give them access in their 401ks? And why don't we make it so that everybody has access to this thing that the rich people have?
Well, the thing is if you loan out so much money, eventually you're going to need more money to loan.
Yeah.
So the easiest way to do that is to open it up to more investors.
I think you can't continue to grow as a private credit company without more liquidity. The problem is that there's only so many loans you can make that are good loans.
100%. And if you have more and more investors coming in, your cash is building up and you have nowhere to deploy it. That's going to get you the same rates of return that you would have received in the earlier stages. We actually had some Blue Owl positions years ago, and it did really, really well. But that space is becoming so saturated now. And when we say private credit, the easiest way that I can just frame this is it's basically giving loans out to middle tier companies.
Or not even always middle tier.
No, so for sure. But with that being said, it's basically just a loan company. Is the easiest way to break it down. And a lot of other companies are coming out with their own private credit offerings. And I was talking with a wholesaler the other day who was saying that the reason why private credit is being pushed so much right now is because for every dollar a mutual fund company makes selling a mutual fund, they make $4 on the private credit. So it's 400% more profitable than the mutual fund offerings. So why wouldn't you want a piece of that space? But the problem is, to your point, is who do you lend money to? Because not every company is going to take out a loan at 6 to 10%.
Yeah. So it's a credit crisis, and it's mostly constrained. And that's what, I think is helping us right now, is that we didn't get to this point of quote unquote democratizing private credit so that every man can have access to this special tool. It fell apart before we got to that point. And what's great is that you and I have been avoiding this space. The more we heard about it, the more we were like, whoa, why are we hearing about this so much? Understand the incentives, and you understand what that person is trying to achieve.
100%. Right? The thing that always scared me about it, and it still does to this day, is how easy money is to access. I don't know about you, but whenever I open up my mailbox, I always have like a loan offer. Whether it's like a home equity loan or like a private loan or this or that. And we get the same stuff for our business all the time. And it's so easy to access money. And so many people are just like willing to give it away at a higher interest rate that, of course, it's a profitable business that people want to get into. But how many people are actually utilizing that service versus the amount of dollars that are being funneled into the space?
Yeah.
That's what scares me about it.
I think that whenever you create more access, to your point, and you reduce the barriers
of entry,
then you run the risk of the wrong people getting access.
That's literally what happened in the mortgage crisis.
Yeah, exactly. Exactly.
Exactly the same thing.
So I think what happened is that we got to a point where this was bad, and it doesn't seem like it's had a contagion level effect where it can affect everybody.
Yeah.
But, at the same time, this is what Jamie Dimon said a year ago. There's one cockroach, there's more likely to be more. And he was right.
Yeah.
And Blue Owl is a publicly traded company. It's down like 60%.
Yeah.
And it should be, I think. But I'm just happy that when there was a carrot dangled, we didn't chase it. And our clients have benefited from that.
Yes. One thing that scares me is, I just thought of this as you were talking. A lot of these private credit companies are not repriced daily.
Yeah. Oh, I know.
They're all, most of them, and I don't want to say most, but a huge majority of them are what's called a BDC.
Yeah.
Which is basically a non-traded company that someone who has, accredited investor, can invest in. And basically you receive a statement of showing the worth of what you have in there, but that doesn't mean that's the value you're going to receive if you withdraw the funds. Yep. Or if you can even withdraw the funds, because we've had companies that have had money locked up for years and years and years.
They gate the door.
Yeah. So it's like, if you can only get a 10% redemption a year, let's say you have $1 million in there. Do you actually have $1 million in there? Or is that just what they're telling you it's currently worth?
Right.
But then when you go to access it, it's actually not that. So
that's what's always bothered me about this. It's two things. It's the liquidity aspect of it, but it's really there's statement risk. And what's funny is that in 2022, the statement risk was owning bonds and not owning something that didn't price daily. Because if you had private credit in 2022, again, it's a loan, just like a bond is a loan. So you can kind of swap them out for each other. Anybody who had private credit in 2022, those funds seemed to hold value that entire year while bonds were down like 18% and just getting smoked. Having publicly traded bonds that year was a statement risk.
Yep.
Now, if you have private credit on your statement, the risk is that it's not worth what you think it is. And that was always the risk.
Yeah.
It's just that people don't care because it says this thing on the paper.
Right. You want to know what it reminds me of is when people often include their home as like a asset in retirement.
Yeah.
It's like, well, you can't access. I mean, yes, I guess you could pull a home equity line of credit out if you desperately needed to on the home, but that's going to drive your value down in the house.
Yeah.
But it's just like, to say that you have $1 million on your statement doesn't mean that you can spend $1 million. Like, that money's available for you to spend.
Yeah.
And we always talk about this. The whole advantage of publicly traded markets is liquidity.
Yeah. It's knowing what the price is.
It's an efficient market.
Yeah.
It's like, that's the thing that sucks about trying to sell a car. It's like, you think you know what the value is, but then when you go into the dealership, they're like, oh, it's actually 30% less than what you thought. And then you have to shop it around to 12 different dealerships.
And then you have like something like gold, right?
Right.
Like, you can see that price changing, but if you have a gold coin, like, you have to go find somebody that you can actually sell this gold coin to.
100% liquidity is the biggest advantage of publicly traded markets, because everybody is going to buy and sell those shares. But if you have a BDC and private credit, this isn't investment advice. I should say that, but it has a high potential of just being a total black hole that you're stuck into. And while they're going to give you a statement that says you have X, that doesn't actually mean you can access X.
Yeah. I mean, if your house is, let's say you think your house is worth $1 million.
Mm-hmm.
In reality, it's worth whatever somebody's willing to pay for it, minus the fees that are associated with that process and any tax on the transition or anything like that. Did you know how sometimes you'll hear like increase in Google search results? Like, you can find data on like, this search term has increased X% over the last couple of years.
Right? I have seen those. Yeah.
You know what search term is skyrocketing right now?
Private credit?
Can't sell my house.
Ooh.
Yeah. And that's interesting because the housing market's broken. We know the housing market is broken.
Yes.
But this is the perfect example of a situation in which, if you think your house is worth something and there's nobody who's willing to pay what you think it's worth, then obviously it's not worth that. And if your plan relies on selling your house for anything, buying another house, paying for long-term care, whatever it might be, that's not a foolproof plan.
What you think something is worth is irrelevant. It's what someone's willing to pay for it is the actual worth of it.
Yeah. So, I agree. All right.
Yeah. I do want to bring up something, and naturally it's AI.
Of course.
And the theory of AGI. And you and I have talked about this before.
Yep.
In the break room.
What is AGI?
Okay. AGI is defined as, or refers to, a machine capable of performing any intellectual task that a human can do. So in order to do that, you have to have autonomy. You have to have reasoning. You have to be able to have emotional context. You have to literally be able to act and interact with the world in the way that a human can, to the point where it's almost discernible.
Yeah.
So that's like very, very different than what we have right now with AI. Because what we have with AI right now is basically like an LLM that, will compute data and will give you an output, but it can't interact with the world. It can't like look at a physical object. It can't dissect it. And a lot of what we do in life and in the world, in fact, the majority of it comes down to those tasks and things that we do on a day-to-day basis. And these word and language models are very important, but there's this fear that people are going to get replaced. And that's like obviously a huge thing. So as I was researching this and just going down this path, I was thinking through, are we going to see these mass layoffs that, people are fearful of? And how much adoption are we actually going to see of AI? And when I say adoption of AI, I don't mean like an AI chatbot and things like that, but like, is AI actually going to be replacing like a lot of companies and functions and things like that? Kind of like what we were just talking about with CRM. So I did some research and I was keen to kind of dissect a few different things, which is we saw huge jumps in technology from ChatGPT 2 to ChatGPT 3, and then especially to ChatGPT 3 to ChatGPT 4. So there is something called Kaplan scaling law, which is the data ceiling. And I just want to read through this a little bit because it talks about like scaling laws with neural language, which sounds like a lot of jargon, but it's interesting. So basically what it's saying is that showing that model performance improves predictably with more computing, more data, and more parameters. So this was the foundation that justified the ChatGPT 3 gold rush. So what I mean by that is the theory of, as opposed to refining the data that goes into models, the theory that more data means a better iteration. So how much more data can you funnel into a model to make it better? And what they found is that increasing the size of it actually made a better product. And that's what happened with ChatGPT 3. So when it advanced to ChatGPT 4, they just shoved way more data in there for it to dissect and learn from. And then it made a huge jump in terms of its productivity. And the core problem with this, though, is that the internet has essentially been consumed at this point. The data's already been pushed into it. So at this point, if it already has the data, how much more can it evolve from there? So have we reached a plateau? And a lot of people think that we basically have already seen the massive iteration jumps in these language models that we're going to see. Certainly it can improve, but you get to a certain point as well where the more data you shove into it, the lower the quality of the data that you're feeding into it becomes. And in the same way that a lot of the data will then become AI generated. So you have AI generating data for other AI platforms. And I guess my whole crux with this is not to say that we're not going to see more adoption, but I don't think we're going to be able to get to AGI anytime soon. And we're probably not going to see so much advancement so quickly as we have already. So then the question becomes, is essentially the amount of expenditure when you add it up between Microsoft, Google, Meta, and Amazon from 2025 and expected through 2027, their combined expected spend is over $1 trillion on these data centers and everything like that. And I'm not convinced that it's going to be like this absolute game changer that maybe everybody was so fearful of a year ago.
Yeah, I think it depends on the function. It depends on what the point is, right? Mm-hmm. And I think AGI, the easiest way for me to comprehend AGI and kind of like give it some relativity is to think about Siri being AGI. Siri being AGI in that it has access to all of my apps, which means that it has access to my Delta app and it can book me a flight, or it can write emails for me, or it can transfer funds from one account to another. I mean, that's crazy. That's a lot of access.
It is.
But that's like essentially a personal assistant is, I think, the easiest way for somebody to comprehend how AGI could impact their lives on a daily basis. But when you think about the enterprise level of AGI or any LLM, I think what you're kind of describing is the opposite of compound growth. It's kind of like it's grown already.
It's stunted growth.
Yeah. And now it's not like every 10% is better. It's really just like the magic has occurred. What got us all excited has happened already. The thing I think about that is a little bit difficult to dissect is that while the data may have been fully absorbed, it's still, I feel like the encyclopedia is complete, right? It's if you want AI to be an encyclopedia, a reference point for you, then that's done. If you want AI to build reports for you, that can either be effective now or it can be continued to improve because like the quality of a report can be continued to improve.
Yeah.
And when you look at a report, let's say I have a scenario and I say, AI, my client wants to make this decision. Let's run through 4 different options and then let's help them figure out what it all means and the pros and cons and blah, 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 blah. What the client really wants is the decision.
The client wants you to tell them what to do.
Yeah. Yes. So if I have a really comprehensive document, that's the first draft the AI is going to put together. And then I have to go through it and say, all right, this is what we want the client to focus on because this is the decision that I know is in their best interest and that they're going to be most comfortable with. Everything else is noise.
Yeah.
Right.
I mean, that's the thing. When you go to a doctor's office, I don't want to have my doctor present me with 4 different ideas.
Sure.
And the pros and cons of each.
Right.
I want him to be like, no, you need this surgery and we're going to schedule you in a week.
Right.
You know?
Yeah.
Like that's
even if
that's
he
the
might
deal.
be wrong.
Yeah. But I just like, you want that reassurance. You want that confidence.
Yeah.
That's the whole thing with it. But I guess with all of this, there's a lot of advantages and we use a ton of it to our own advantage and building out, you know, certain things that help our business and things like that. But with that being said, and we talked about this briefly, but you have these companies that were very asset light and super profitable.
Yeah.
You know,
because,
technology
the
and
margins
software.
were great.
Technology and software is one of those things that doesn't require that much build out to make a really great product.
Yeah.
And that's why you have all these companies that, you know, in a year or two went from being nothing to creating a program that was acquired for $1 billion and these people made all this money and blah, blah, blah. Yeah. But now you have this capital expenditure that's being like spent out. And this kind of reminds me of like the cell phone industry. And we talked about this briefly, but if you go back to like BlackBerry, and BlackBerry was like such a huge thing, everybody used it. And then iterations of other phones got better. And then the iPhone dropped and just made it not totally irrelevant, but they didn't keep up at that point in time. And I guess my thought in theory is that while ChatGPT and Claude and all of these things are really good, the model's been built for someone to come in and disrupt.
I think that the problem is that there's no moat around any of these companies.
Of course.
You know, ChatGPT was the thing until Claude became the thing.
They had 87% market share at this time last year. Now they're down to 65.
Right. And between, you know, that what I just described of ChatGPT to Claude, Gemini was the hot thing for like a month.
Yeah.
So I think that an XAI is like the one that cooperates with the government. So they'll get the government's incentive. And like there's so much out there. And, you know, Salesforce just came out and reported they're getting crushed because they're threatened by AI. And they're like, well, we're going to build our own AI. And then it will be better than your AI. And then there's just no moat around any of it. And I think what's interesting to me about a company like Salesforce is we've gone through the process of changing out our CRM. And it sucks.
It was terrible.
It's brutal.
It took months.
And we did it twice. And I understand that the migration might be made easier by AI, but also AI messes up all the time and it's unreliable. And you can't have CrowdStrike, which is a cybersecurity company, plummet 30% because AI might provide cybersecurity. AI is in no way capable of providing the service that CrowdStrike provides.
Does. But people see that and they just automatically assume that they're irrelevant.
Ready,
now.
fire, aim.
Yeah.
So that's definitely, it's a good thought. It's have we plateaued? I wonder. I don't know. I kind of hope not because I really want Siri to be better. But
I would love to be able to ask my phone to plan a trip and book the trip.
Yeah.
And then also go pick up my dog from daycare.
Go pick up. Then you need the robot.
I need the car.
You need the robot.
I need the robot or the car, which by the way, the Tesla robo taxis apparently coming out in June, I think, or
Sure.
July.
Yeah.
Whether or not that's June of this year.
Yeah.
Is a question mark, but yeah.
You know, I heard something. I'm just going to pivot real quick into this. It's related,
Yeah.
but the way to think about AI as a threat to your job, not just you, but anybody's job, is to think about whether AI is performing the easy task or the hard task. And when you think about disruption in the past, if you had cab drivers, for example, cab drivers, to be a cab driver, the hard thing to figure out was not how to drive the car. It was to memorize all the maps, to know where to go. When you remove that barrier of entry with Google Maps or with Uber, then the value of that knowledge plummeted. It doesn't matter anymore that you know every corner of every street, because so does Google Maps. And so does whatever Uber or Tesla or Waymo technology. So that value is gone. If some technology came in and replaced that hard work, that's gone. So if let's say your value as a financial advisor is to memorize the CFP and to know everything there is to know about financial planning, that, to what we were just talking about, is available in the LLM. You could have a really smart, very factual, very comprehensive LLM encyclopedia of every financial term. If your value as a financial advisor is to help people navigate decisions, to understand their psychology as an investor and as a client, to help them just get to where they want to get in a kind and, I would say, understanding way, that's a different intangible value that AI does not offer. Even AI that will offer psychological advice or therapy of it, whatever, that's still not a human connection.
No, I think at this point, the data is the data.
Right.
A lot of AIs can do the same thing. Like the difference between Claude and ChatGPT and Gemini, you could argue one's better than the other, but they're all going to be doing the same basic thing in output. So with that being said, in my mind, the next frontier is execution.
Right.
And
making sure
everything's done and done correctly. And that is going to require a lot of trust and a lot of integration with many other apps. And then you have security and things like that. And to your point, anyone can Google data, and that's been available for a long time. And in the same way that now you can use ChatGPT to do research or whatever it might be. But the actual execution, the actual understanding, and the actual decision-making part is, in my mind, where the value is added.
Well, it's like, you can bring a horse to water, but you can't make him drink. Right? It's really easy to find the water with AI.
Right.
But that doesn't mean that you know what to do next.
Exactly.
And I think that we always talk about the relationship and the operations.
Yes.
Those are the two most important things. And I think that there's still a lot of value there in our business and a lot of other businesses.
100% agree.
Okay. Last thing.
Okay.
Dawson died last month. James Van Der Beek died of cancer. I think colon cancer, actually.
He was young, wasn't he?
He was young. And I think he developed colon cancer before the recommended screening for colon cancer. So, tragedy, obviously. He leaves behind a wife and 6 kids. He was he was doing arguably everything right, health in terms of his health. He was doing his cold plunges and he was running a lot and he was
healthy guy.
He was working on a ranch when he wasn't working as an actor.
Okay.
Shortly after he died, there was a GoFundMe campaign to raise $500,000 for his family because the family they were out of funds. He successfully raised $2.7 million, which is pretty impressive.
Sizable.
But also raises some questions. Like, how much money did this family really need and why? And I think, arguably, it's very easy to understand that when you are fighting cancer for 4 or 5 years, that's a really expensive process. And you can either go through your life savings and ask for help, or you can
get insurance.
You could break bad and, go start a drug cartel.
Yeah.
So they obviously went through a very expensive process. And whatever he made in his career as an actor, it wasn't enough, apparently, to pay for the medical care that he needed once he was diagnosed with cancer.
I have a question.
Yes.
He clearly didn't have insurance.
Getting there.
Okay. Got it.
So here's what he did have. He continued to work. He danced with the stars for one season. He sold off memorabilia. from Varsity Blues and Dawson's Creek, etc. But he also had 6 kids and a family and was living on this ranch that they were renting. I think they went there in 2020. And they rented this ranch just outside of Austin, arguably maybe like, let's call it $10,000 a month right there. 6 mouths to feed in addition to his and his wife. Not a lot of money coming in from his acting gigs at that point. Like his star had quote unquote fallen to a degree. Shortly before he died, his family purchased the ranch for a little bit more than $6 million.
Okay.
All right. Now, hard on your sleeve. Let's give the kids some continuity. They lived in this place for 6 years, right? They just lost their father. We want to have some sort of stability in their lives. So we'll figure out a way for this family to buy this $6 million ranch.
Hang on a second. They bought the ranch after he passed away.
The month before.
The month before.
Before.
Got it.
And then he dies, and then the family has no money, and they have to start a GoFundMe. So I think there are a couple of things here. And again, we're not overly familiar with the situation. My first thought was yours. He must not have had life insurance, right? And he couldn't get it after he's diagnosed with colon cancer.
Or health insurance.
Health insurance will only pay for so much. And if he probably had SAG, which is the union life insurance, health insurance, but it wasn't paying for all the bills.
Okay.
So like health insurance pays for a lot, but it doesn't pay for everything. Not everything's covered.
Right.
Especially in the United States in 2026.
Yeah.
But so health insurance wasn't enough to offset the bills that they were paying along the way. And then apparently there's no life insurance to take care of the family after he passes away. And so then they're left without enough money to pay for their very expensive ranch, but also for their very large family. And it's, to me, a situation all around that was probably avoidable. Cancer is a shitty thing that happens.
Yeah, it sucks.
But, medical expenses are really hard. There's choices that are made along the way that look bad in perspective. Like if you're worried that your family might run out of money, you might have to make some choices at some point to maybe not live on this massive ranch outside of Austin, but also to maybe get some insurance while you're young and healthy. And I think that last part is something that people forget about because, the first thing I did when Jess and I realized we were going to have a child was get life insurance, and not expensive life insurance, like cheap term insurance.
Oh, it's so cheap.
Right. And if you qualify for it, it's really hard to argue against getting it. So whenever I hear about something like this, like an actor who dies or somebody who was very successful financially and they die and their family doesn't have any money, I think about how it could have been avoided. And there's probably estate planning and there are probably budgeting decisions, but there was also probably a lack of insurance.
It's also a lack of advice.
Yeah. I don't know who is providing advice in this family.
But that's the thing. And I know people give every industry a hard time, but we often get a bad rap. And certainly there are a lot of sketchy advisors out there doing some sketchy things. There should be basic principles, though, when it comes to financial planning. And I think estate planning, and no one likes to talk about insurance, and everybody feels sold on insurance until you need it. Like when I was talking about this with Kaylee, and as we do our own life plans and financial plans and things like that, like I never want there to be a time where if I'm not here, she can't continue to have the life that she needs. And if that requires me to spend an extra $40 a month for some additional term insurance, that's great. Because to me, worst case scenario would be exactly what just happened, which would be I'm diagnosed with cancer and I have to live a year with myself knowing that my wife and family are going to struggle. So if that's the case, and that's a concern, just get it done.
Yeah. And I think obviously, he fought cancer for, I think it was 4 years, maybe it was 2, I can't remember exactly, but he definitely had an ongoing battle with cancer, and they had time to figure out, for example, how to go from renting to buying this property and figure out how to set the family up in his absence. But by all accounts, this guy was loved. He was loved by the people in his family, outside his family, just like by the community. They raised $2.7 million in a GoFundMe. That's hard to do. And a lot of it was not just here's $100,000 from rich guy A in Hollywood. There were solutions somewhere along that way. And you got to wonder to your point, what advice he was receiving. But it's heartbreaking for me to think about the family left behind that's already dealing with all of this loss and mourning. And on top of that, there's financial stress.
You want to know what actually breaks my heart even more than that is the fact that this happens all the time to people that haven't been Hollywood stars or have a social media following that don't get that funding, that don't get the $6 million ranch and are really hurt by that and don't get the support. While I'm super happy for the family and the kids that is the case, I find it a little, I don't know, heart-wrenching as well that, this stuff happens and people don't get that. And the reason why he did get it was because he's famous.
It's very true. And it's, we can celebrate that for him in that situation while at the same time acknowledging that there are a lot of people who were not that fortunate.
Right.
Yeah. So anyways, don't want to end on a sour note. I apologize. But again,
get your estate planning done.
And we'll talk about this more at length in another episode. But there are a lot of choices that can be made that can lead to a better outcome. Yeah. All right. That's our recap.
Let's wrap it. Yeah.
If you enjoyed, Colin, this conversation today,
like, subscribe, and share with a friend.
Yeah, share with a friend. Yeah. I like that last part.
Share with a friend.
Share with a friend. Share with an enemy.
Share with a colleague. Share with a stranger.
Share with AI.
Share with someone.
Feed it into LLM and then tell ChatGPT to recommend our show.
Yes, exactly. To everyone.
Thanks, Colin.
Thank you. Yep, thanks.
The information in this material is for general information only and is not intended to provide specific advice or recommendations for any individual. Investment advice offered through Integrated Partners, doing business as Ko-Fi Advisors LLC, a registered investment advisor. Integrated Partners does not provide legal, tax, mortgage advice or services. Please consult your legal tax advisor regarding your specific situation. Past performance is no guarantee of future results. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful.
Compound Growth with Wheeler and Colin, sponsored by Ko-Fi Advisors. Reach out today. Yay!